Greetings to all on behalf of my group and I. We are now going to present on whether the launch of the Crest white strips would be profitable or not. The NPV was calculated in dollars and thereafter was converted into rands using the average Q1 2019 FX rate of 14 rand 69 cents per dollar. Cannibalization is the reduction of the sale volume. Therefore, the NPVs of the premium and basic cannibalized products need to be subtracted from the advanced seal NPV. This NPV indicates that the project will obtain a greater return than its cost of capital. The positive NPV should increase the market value of P&G, which will in turn increase the wealth of the owners by an amount of 224,968,423 rand 10 cents. Therefore, the decision will be to launch the Crest white strips in the US. Now I will be handing you guys over to Karisha, who will explain the break-even analysis. Thank you.
According to the accounting break-even, we need 100,000 units to break even each year, and our annual volume is 2 million units. Therefore, the 100,000 units needed to break even represents 5% of the total annual market size. The present value break-even states that we need 271,542 units to break even, which represents 13.5% of the total annual market size. Therefore, it is safe to say that there's enough potential in the marketplace for us to recover the initial investment. Although it places us at risk since it can be easily attained by new entrants in the marketplace. The disadvantages of the accounting break-even is that it fails to account for the opportunity costs of the initial investment, and depreciation prevents us from calculating the true costs of recovering our initial investment. I will now hand you over to Nokolo, who will be discussing the sensitivity analysis.
Thank you, Karisha. I will now move over to the scenario analysis of our launch so that we can investigate the degree to which the various scenarios can change before the decision advice given by the NPV is overturned. The first three scenarios that we dealt with were the $1 price increase, the $2 price increase, and the advanced sale with no cannibalization. The $1 price increase had an annual increase in sales of 600,000 units. The $2 price increase had an annual increase in sales of 300,000 units. After working with all the necessary cash flows, we can see that with the first three scenarios that I mentioned above, they all had positive NPVs. The $1 price increase had an NPV of 367,801,670 cents. The NPV for the $2 price increase was a bit lower than the $1 price increase, but it also had a positive NPV of 129,428,933 cents. With the advanced sale with no cannibalization, its NPV, however, was 337,847,175.26 cents. All the three scenarios that I mentioned above all had produced positive NPVs, and when we worked it out in dollars and in rands, it all produced positive NPVs. Thus, this indicates that our project will then obtain a greater return than its cost of capital. I will now hand over to my colleague, Mr. Fanele Sibonge Ngalane, to continue with the rest of the scenario analysis.
So still continuing with the scenario analysis, after taking into consideration the effects of the basic product, we have realized a positive NPV of 389 million, which of course indicated that the project should be accepted. Then we moved on to the next scenario, which was high cannibalization, which also had its own positive NPV figure of 583 million. Then the last scenario was low cannibalization, which also resulted in the positive NPV figure of 392 million. So we concluded that the scenario analysis provides sufficient information about its positive NPV, and that it should increase P&G's market value as well as shareholders' wealth.
Looking at our base NPV for the Crest White Strips Advanced Seal, we can certainly say that it will pay off for our business due to its large size. A large base NPV means large profits and thus more cash for shareholders. Since this base NPV includes initial cannibalization estimates before the P&G team recheck the volume amounts, the NPV of 225 million rand is at first glance encouraging to see, as operating cash flows have a strong positive amount of 5.18 million rand, not accounting for net working capital resale. By choosing to increase the price to $23 under the adoption of new technology, our NPV looks even stronger, as OCFs start from small and then quickly increase over the 4-year lifespan, eventually giving us about 368 million rand. However, choosing to increase the price to $24 under the use of new technology will dramatically weaken our cash flows and give us about 129.5 million rand. This clearly shows that we could be pricing this product much too high, which can drive away our customers. Conclusively, our maximum pricing limit for advanced sale would be $23. When deciding on the product placement options, the option to increase driving trial will result in an NPV of around 584 million rand, which reflects the possible effectiveness of increasing the marketing of the new product to customers. On the other hand, decreasing driving trial may result in less cannibalization, but in less marketing of the product, which further leads to a lower NPV. When looking at the risks that can come with this product launch, we believe exchange rate risk that is one of the biggest risks for most South African firms. We have seen our rand showing weakness against major currencies such as the dollar. Due to events happening in South Africa affecting our economy, the rand has been struggling to match the value of the dollar for a long time. The good thing about a weak currency is that we could get more rands from the US at a large exchange rate, but we cannot also forget that the currency can rise in value, which can lead to less foreign cash flows. Political risks in terms of the trade war between the US and China can also be a big impact on our economy, and specifically for P&G South Africa. When the US issues large tariffs on Chinese imports, the US economy shrinks in terms of less exports, less GDP, and less employment. The rest of the world feels this effect trickle down into their economies as well. And when being specific to P&G, we could face the inability to manufacture the product in a cost-effective way and to sell at the price that would maximize our cash flows within our project life. I will now hand you over to Kanyisile Masia.
The last aspect to talk about is the design process. During the design process, we need to be thinking about the P&G core strategy, which consists of the 3 main pillars, namely being able to attend to more customers, being able to compete in more parts of the world, and lastly, being able to completely change our existing product to solve customers' needs. We also need to bear in mind the cost of technology, whether we are able to finance the cost of technology. We also need to be thinking about the availability of materials, whether we have materials available at each and every moment in order to avoid material shortages. We also need to be thinking about the unboxing experience, whether the customers will need to unbox the product themselves. We also need to determine whether our product will be a luxury or a utility. On our break-even analysis, we noticed that we need only 5% of the market size to break even according to the accounting break-even point of view, and 13.5% according to the PV break-even point of view, which give us enough room that our business will recover our initial investment. Looking at the scenario analysis, we recognize the best case where our sales far exceeds our cost and giving us a positive NPV. We also calculated a positive base NPV, which placed us in great financial position in launching our new product. Based on this financial justification from P&G facts and also the calculations which were calculated so far, we can boldly say that we are better off in launching the new product. Therefore, we can boldly say that the new project will pay off for us, and we are also financially fit, or we are financially justified in launching the new Crest White Strips. Thank you for watching. Bye.